Hello friends, we are finally ready to analyze a real company. I chose Brickability Group. It is a UK-based distributor of construction materials. It is quite a big jump for us, from a lemonade stand with several $1,000s in sales to a company with hundreds of millions in revenue. But I think we can do it. Brickability Group is a publicly traded company and we can find their investor relations page online. So we just type in Google Brickability Group investor relations, and this is the first link. Then we scroll down and we can see the latest annual report. Let's open it. So we can see that our year ended is 31st of March 2024. For most companies, financial year end is the same as the calendar year end on 31st of December. But still there are many companies with unusual financial year ends, just like Brickability. So their financial year begins on 1st of April and ends on 31st of March. And first thing I would do is check auditor's opinion regarding the financial statements. So we can go to page 65 and we can see that financial statements give a true and fair view of the state of the group's and of the parent company's affairs as at 31st of March 2024. And we can also see that financials are prepared in accordance with UK adopted international accounting standards. I made a quick research and the UK adopted international accounting standards are very similar to IFRS and there are only very minor differences. So at this stage I think we are okay. Next I will check who was our auditor. So we go to page 71 and at the end we can see that the auditor is BDO. Ideally, your bank should have a list of audit companies who your bank is comfortable to work with. And let's assume that BDO is on that list. But then you might have a question. What if the audit company has a bad reputation, or maybe the company doesn't even have an auditor? They just shared with you management accounts and now you need to do a quick screen. In that case, first thing I would do is make a quick screen for obvious accounting mistakes. So I would go to page 74, which is our balance sheet, and I would just check the basics and start with total assets and check that they equal to the sum of total liabilities and equity. So we can see that total assets are 451 million and our total liabilities are 259 million plus total equity of 192 million, which equates to 451 million. So our total assets equal to the sum of liabilities and equity. This is very basic, but I've seen management accounts where assets do not equal to the sum of liabilities and equity. And that would question the reliability of financial statements, because it is the most basic rule. Then I would check that our cash and cash equivalents on the balance sheet are equal to the cash and cash equivalents at the end of the cash flow statement. So here we can see that our cash and cash equivalents at the end of 2024 are 15.6 million. Then we go to page 78. This is our cash flow statement. And this, if you remember, we have operating cash flows, then investing cash flows, and then financing cash flows. And when we add these cash flows together, we have total cash flow for the period. And when we add total cash flow to the beginning cash and cash equivalents, we get ending balance of cash and cash equivalents. So in our case, the ending balance of cash and cash equivalents is 6.9 million. This is very strange because it does not equal to the cash and cash equivalents on our balance sheet. So we need to explore why. We have note 40 and this note 40 is on page 126. And here we can see that actually the Brickability Group includes bank overdrafts in their cash and cash equivalents balance on the balance sheet. And what are bank overdrafts? So Brickability Group has a lot of companies in the group, and at times some of the groups may run out of cash. And they call their bank and say, hey, I run out of cash, can you please provide an overdraft? And bank can cover short-term liabilities for the company. So in our case, the Brickability Group didn't actually have this cash, so we subtract bank overdrafts from cash and bank balances, and we get cash and cash equivalents of 6.9 million, and it is equal to the amount we saw at the end of the cash flow statement. Again, this is very strange. I rarely see this, but this is in accordance with the accounting standards. In most cases, you would see cash and cash equivalents at the end of the cash flow statement equal to the cash and cash equivalents balance on the balance sheet. And if it is not equal, then you need to check why, just like we did here. So we go to our balance sheet on page 74. And next thing I would do is check the retained earnings balance. If you remember, we have beginning retained earnings balance, then it is increased by net profit during the period, and it is decreased by dividends, and we get our ending retained earnings balance. So what is our beginning retained earnings balance? It is our ending retained earnings balance for the previous period. So we can see that for 2023, we had retained earnings of 55 million. So to our beginning retained earnings balance, we need to add net profit. We go to page 73, which is our profit and loss statement. And we can see that our profit for the year was 15.4 million. And what decreases our retained earnings balance are our dividends. So we go to page 79, which is our cash flow statement. And we can see that our dividends for the period were 9.9 million. So 55 million of beginning retained earnings balance, plus 15.4 million of net profit, and minus 9.9 million of dividends, and we get 60.5 million of retained earnings balance at the end of 2024. And we go to our balance sheet, and we had 60.5 million in retained earnings at the end of 2024. Then final check that I would do is check for any weird and unusual numbers. So for example, if we go to page 73, which is our profit and loss statement, we can see that the revenue for 2024 was 594 million and 76,000 pounds. And that's okay. For me, unusual or weird number would be something like 500 million. So 5 and many zeros. And then I would think that the accountant just made this number up, because we rarely see very round numbers in the actual business performance. So if you see a lot of unusual numbers, then you need to explore what is happening. I would also check for unusual ratios. So for example, if we have growth in revenue from 2023 to 2024 of 15.63%, that's fine. For me, unusual ratio would be something like 15.000%. Then I would again think that accountant made these numbers up. And for the initial screening, I think that's enough to check these basic accounting mistakes, and we can proceed with our financials. So first thing we want to do is understand who we are working with. So we go to page 2, and we can see that Brickability Group is a leading distributor and provider of specialist products and services to the UK construction industry. And I prepared a short presentation for you. And as you can see on the first slide, Brickability Group has a lot of companies, and they split their group in 4 segments: bricks and building materials, contracting services, distribution, and importing. Let's have a look at each segment separately. So bricks and building materials is the largest segment of the group and represents 59% of total sales. And I would say that most of the sales in this segment come from brick merchandising. Then we have contracting segment. It is 14% of total sales, and these are mainly construction services, installation of roofing and flooring. Then we have the smallest segment of the group, distribution, which represents 8% of total sales. These are mainly products at the final stages of construction, which are windows, doors, radiators, and sustainable technology solutions. And finally, we have importing segment, which represents 14% of total sales, and these are bricks and building materials imported from other countries. I think for the screening stage it is enough, and we can go back to our financials. I would start with the balance sheet. And here at the top, on page 74, we can see that we are looking at consolidated balance sheet. And if we move to page 75, there is company balance sheet. Company balance sheet is our parent company's balance sheet. And the consolidated balance sheet is the balance sheet of the entire group. And I think it is important to understand how these consolidated financials are prepared. They remove all intercompany transactions. So for example, subsidiary 1 sold the product to subsidiary 2 for $100, and then subsidiary 2 sold the product to final consumer for $120. And if we do not eliminate intercompany transactions, our total revenue would be $220, which is obviously incorrect, and we need to remove this intercompany transaction. So you should imagine that we are just looking at the group as one company, and this is what our consolidated financial statements provide to us. So if we compare the consolidated balance sheet with the balance sheet we saw for our lemonade stand, it looks much more complicated, but I want to simplify it to you. So let's have a look at our assets and how they are equal to our liabilities plus equity. So you remember, balance sheet is a photo of a company. And if we would take a photo of a Brickability Group, what would we see in long-term assets? These are, of course, retail shops and brickyards where the company sells their products. Then we would also see warehouses and offices, and we would see vehicles to move all our inventory between warehouses and retail shops. And in current assets, we would see, of course, inventories in our warehouses and in our retail shops, and we would have accounts receivables from our customers. So construction companies purchased construction materials from us, and they promised to repay us later. And we have, of course, cash. Next, we have equity, and in equity we have capital injections from our shareholders, and we have retained earnings. And retained earnings are net profits generated during the lifetime of the company after we subtract all the dividends and share buybacks. So you can imagine, each year the company is generating net profit, and if we did not distribute dividends, this net profit stayed inside the company, and we purchased assets or repaid liabilities with these retained earnings. And why we decrease retained earnings by dividends? Because dividends left the company, they left our balance sheet. I think it makes sense. And then in liabilities, in long-term liabilities, we would see bank loans, and in short-term liabilities, we would again see short-term portion of bank loans, and we would see payables to our suppliers. So suppliers provided products to us, and we promised to them to repay at a later date. So I think if we look at this picture, it makes much more sense, and the real balance sheet of the company should not deviate too much from what we discussed in this picture. So we get back to our balance sheet, and at the screening stage, I think we should focus on material items. So I would ignore all items that are less than 3% of our total assets. So what do we see in non-current assets? We have property, plant and equipment of 27 million, and as we discussed, these are our warehouses, offices and retail shops. And we have right-of-use assets of 21 million. Right-of-use assets are buildings and vehicles on long-term lease. And there is a specific accounting standard, IFRS 16, which tells us that material operating assets under lease should be shown on the balance sheet. At this stage, to simplify, let's assume that Brickability owns these assets, and if you want to dig deeper, I provide explanation of IFRS 16 to the description of this video. Next, we have intangible assets of 226 million pounds. And this is related to acquisitions of a Brickability Group. And it would be best to explore this with an example. Let's imagine that a Brickability Group wants to acquire a company in Scotland. It is a logistics company, and its book value is 10 million pounds. But book value does not capture the entire value of the company. There are many items that are difficult to put on the balance sheet. So for example, this may be exceptional talent of the company, or they have good reputation with suppliers and customers, and maybe they have patents and technologies that are valuable to Brickability Group. And Brickability Group decides to acquire this company for 20 million pounds. So 10 million pounds in excess of the book value represent goodwill, which is a part of intangible assets. So we see that 226 million is a big figure, and this is related to a lot of acquisitions that Brickability Group has done in its history. Next, we have current assets, and here we have inventories of 29 million, and this represents the raw materials and products in warehouses and retail shops of the company. And we have trade and other receivables of 113 million. These are receivables from our customers. So these are mainly construction companies who purchased building materials from us and promised to repay to us at a later date. And of course we have cash and cash equivalents of 16 million. And then we move on to current liabilities. And the biggest item here are trade payables of 117 million pounds. These are payables to our suppliers. So we purchase bricks and other building materials from our suppliers, and we promise to repay to them at a later date. And then in non-current liabilities, we again have trade payables of 24 million, and these are payables which we do not expect to repay in the next 12 months. And next we have loans and borrowings of 63 million. These are loans from a bank. Then we have lease liabilities of 15.1 million. And as we discussed, on the asset side we have right of use assets, and to balance them on the liabilities side we have lease liabilities. At this stage we can think that these lease liabilities are loans from a bank that we use to purchase right of use assets. And if you want to dive deeper into this, as I said, there is a explanation of IFRS 16 in the description to this video. So then we are moving to the equity side, and the largest balance here is a share premium account of 103 million, and these are funds that the company received during the IPO process. So the company decided to go public and they sold shares in the company and received 103 million. Next we have merger reserve balance of 20.5 million, which is again related to acquisitions of Brickability Group. Next we have retained earnings of 60.5 million, which are all the net profits during the lifetime of the company after we subtract all the dividends and share buybacks. So these are essentially earnings that are retained inside the company. So we have broken down balance sheet, and I hope it makes sense to you now, and we can move on to the profit and loss statement. So we go to page 73, and here we can see that for 2024 there are three columns: adjusted column, other column, and total column. I would suggest that at screening stage we ignore adjusted and other column and just focus on the total column. And at a later due diligence stage we will explore why they made all the adjustments. So they had revenue of 594 million and they had cost of sales of 488 million. So this is cost of the products that they sold. And they have a gross profit of 106 million. Then I suggest we again look at material items. So our next material item are my administrative expenses of 84 million. And within administrative expenses, we can see there is depreciation and amortization of 15.9 million. And then we also have finance expenses of 6.9 million, which are interest paid to banks. And we have fair value gains. And these fair value gains relate to the acquired companies. And we will explore this amount at a due diligence stage. So now we have profit and loss before tax. We have a profit of 21.4 million, and when we deduct income taxes of 6 million, we generated profit for the year of 15.4 million. I think it is relatively straightforward, and we can move to cash flow statement. So we go to page 78, and again, if you remember, we have operating cash flow, investing cash flow, and financing cash flow. And when we add them together, we get total cash flow for the period, and when we add total cash flow for the period to the cash and cash equivalents at the beginning of the year, we get our cash and cash equivalents for the end of the period. So we begin with operating cash flow, and it starts with profit for the year, and we need to make necessary adjustments to see actual operating cash flow for the period. And again, let's look at material items. So the first three items we see is depreciation and amortization expense. So 1.7 plus 3.9 plus 10.2 million. And then we see next material item are fair value changes in contingent consideration. This is related to the acquired companies, and again we will explore this item at the due diligence stage. Then we add back finance expenses. These are interest expenses which we will show separately in the financing cash flow. So we add back finance expenses and we add back income tax expense, because we will show actual tax paid at the end of the operating cash flow. So we get operating cash flows before movements in working capital of 38.5 million. And then we have changes in working capital. We have a decrease in inventories of 3.3 million. That means our balance of inventories has decreased during the year. And to give you a better idea, let's have a look at an example. Suppose we had $30 of beginning inventory, and what increases our balance of inventories are inventory purchases. And let's assume we purchased $100 worth of inventories. And what decreases our inventory balance are inventories used in cost of goods sold, which in our case is $120. And we get ending inventory of $10. So you can see in the revenue, we assumed $120 outflow for the inventories, but we actually spent $100. So we overstated by $20, and we need to add back these $20 in our cash flow statement. And this is what we did here by adding back 3.3 million. We overstated the amount of cost of goods sold in profit and loss statement by 3.3 million and make adjustment here. Then we have decrease in trade and other receivables of 14.4 million. And again, it means that our receivable balance has decreased during the year. And let's again explore it with an example. We again can assume that our beginning receivable balance is $60, and what increases our receivable balance are sales on credit. So we can assume we made $50 of sales on credit during the year. And what decreases our receivables balance are receivables that were repaid during the period of $70. So it decreased our receivables balance, and we have ending receivables balance of $40. So you can see that in profit and loss statement we have shown that we made $50 of sales on credit, but we actually received $70. So we received more by $20. So we need to add back $20 in our cash flow statement. And that's what we did here. We add back 14.4 million. So our profit and loss statement did not account for this 14.4 million that we received from our customers. Next, we have decrease in trade and other payables of 20.8 million. And again, it would suggest that our payables balance has decreased during the year. Let's explore again with an example. We had $100 of beginning payables, and let's assume that we made purchase on credit for $50. And purchases on credit increase our payables balance. And what decreases our payables balance are payables repaid to our suppliers. So let's assume that we repaid $80 worth of payables to our suppliers. So our ending payables balance is $70. So we included $50 in our profit and loss statement, but our actual cash outflow was $80. So we need to account for this $30 as an outflow. And we have cash generated from operations of 35.4 million. And we then deduct income taxes that we actually paid of 8.6 million. And we have total operating cash flow for the period of 26.6 million. I hope it makes sense. And now investing and financing cash flow are much simpler to understand. So in investing activities, we have purchases of property, plant and equipment for 6.1 million. And we have acquisitions of subsidiaries for 42.8 million. It's relatively straightforward. And we have net cash used in investing activities of 50.9 million. Next, we have financing cash flow. We have dividends paid of 9.9 million. We have proceeds from bank borrowings and repayments of bank borrowings. The amounts are relatively high for the proceeds and repayments because these are mostly working capital loans. So it means we borrowed short term, so we borrowed money from a bank, purchased inventories, then we sold inventories maybe within a month or two, and then we repay the whole loan amount back to the bank. So we are not borrowing long term. So we borrowed multiple times during the year and we repaid multiple times during the year, and for that reason the amount of proceeds and repayments are quite high. And we will come back to this at the due diligence stage. So our net cash from financing activities is 22.4 million. When we add operating, investing and financing cash flow, we get a total cash flow for the period. And this concludes our cash flow statement. If you remember, we are at fundamentals stage of our course series. And I think that if at this stage you can read financial statements, it is a good progress. But let's just make a quick screen of financials to see if it is a good potential client for us or not. And if you remember, the first thing that we would look for is whether the company is profitable or not. So we go back to page 73 and we can see that our company was profitable. They generated 15.4 million in profits, but unfortunately the profits have declined in comparison with 2023 from 28 million pounds. And from what we know, in the real estate sector, there was a high inflation and there was a substantial increase in mortgage rates. So there is less demand for new housing. And despite these structural problems, the company was still profitable in 2024. Next, we would check if revenue is growing or is at least stable, because decline in revenues would indicate structural problems that we would need to explore. And in our case, we can see that revenue has declined from 681 million in 2023 to 594 million in 2024. And this is again for the reasons we just discussed. And at this stage, we believe that this is a short-term macroeconomic problem. And in the long term, the housing market should stabilize and we would again see growth in revenues. Next, I would check for margins. These are gross margins and EBITDA margins. And we would want to see growing or stable margins. And the decline in margins would again indicate structural problems that we would need to explore. So gross margin is relatively simple. We just divide gross profit by revenue. So for 2023, we divide 112.9 million by 681 million, which equates to 16.6% gross margin. And in 2024, 106 million divided by 594 million, we get a gross margin of 17.8%. So our gross margin has increased from 16.6 to 17.8%, which is a good sign, especially given the tough construction market in the UK. Then we would need to calculate EBITDA margin. So if you remember, EBITDA is earnings before interest, taxes, depreciation, and amortization. So we have earnings before taxes, which is profit before tax here, of 21.4 million in 2024 and 34.5 million in 2023. And we need to add back interest expenses, and they're provided in finance expenses, which is provided in note 12. And note 12 is on page 94. So we add back for 2023, we had profit before tax of 34.5 million. We add back 1.7 million of interest on bank loans, and we add interest on lease liabilities of 0.7 million. And we get earnings before interest and taxes of 36.9 million in 2023. Then for 2024, we had earnings before taxes of 21.4 million. We had 3.6 million of interest on bank loans and 0.9 million on interest on lease liabilities. And we get earnings before interest and taxes of 25.9 million in 2024. So our final stage is to add depreciation, and in our case it is provided in the profit and loss statement. So we add back to EBIT of 36.9 million in 2023. We add 13.1 million of depreciation in 2023 and get EBITDA of 49.9 million. And for 2024, we had EBIT of 25.9 million and we had 15.9 million of depreciation and get EBITDA of 41.9 million in 2024. So now to calculate EBITDA margin, we just divide EBITDA of 49.9 million in 2023 by revenue of 681 million. Our EBITDA margin for 2023 is 7.3%. And for 2024, we divide EBITDA of 41.9 million by 594 million in revenues. We get EBITDA margin of 7%. So our EBITDA margin has declined from 7.3% to 7%, which again probably relates to the reasons we discussed earlier. Then we want to check leverage of the company. So we go back to our balance sheet on page 74. And first ratio, if you remember, are liabilities to equity. It is also called debt to equity ratio. So our liabilities were 259 million, and if we divide by our equity of 192 million, we have a debt to equity ratio of 1.35. So ratio above 1 would indicate that we have more liabilities than equity, but we need to be very careful here, because if you remember, equity value on the balance sheet does not fully reflect the entire value of the company. You remember that the company has exceptional talent, patents and technologies, and maybe great reputation on the market with suppliers and customers. And all these values are not fully reflected on the book value of the company. So this ratio is useful, but we need to understand the limitations. Next, we can calculate a debt to EBITDA ratio. So in our debt, we would also include lease liabilities, because lease liabilities are very similar to debt liabilities, and I want to include them. So for 2024, we have 8.6 million of short-term loans and 3.9 million of lease liabilities. And in long-term debt, we have 62.9 million of loans and 15.1 million of lease liabilities, which equates to total debt of 90.6 million. Then we divide 90.6 million by our EBITDA of 41.9 million and get debt to EBITDA ratio of 2.2. 2.2 is adequate leverage, and we would be concerned if it is above 3, but at the screening stage, it looks okay to us. Then we would check liquidity, and if you remember, our ratio is current assets divided by current liabilities, and ideally we want to have more current assets than current liabilities, so we would want our ratio to be above 1. So we divide current assets of 169 million by current liabilities of 129 million and get current ratio of 1.3. For our screening stage, this is adequate liquidity, and we will dive deeper during the due diligence process. Next, we want to check cash conversion. EBITDA is accounting income of the company, and we cannot repay our loans with accounting income. We need to see if the company is generating enough cash. So we want to check how much of the EBITDA is converted to operating cash flows. So we divide our operating cash flows. We go to page 78 of our cash flow statement, and we can see that our net cash from operating activities is 26.6 million. So we divide 26.6 million by our EBITDA of 41.9 million and have a ratio of 0.63, which means 63% of our EBITDA was converted to operating cash flows. And at the screening stage, I think EBITDA conversion above 60% is okay. And again, we will explore further during the due diligence stage. So this concludes our screening process. And what can we say? The company is profitable despite the challenges in the construction sector. The company has adequate leverage, adequate liquidity, and they have a healthy cash conversion. So we can come back to Brickability Group and tell them that we are interested to conduct further due diligence and that we are potentially interested in working with them. So this concludes financial statement series, and in the next video we begin covering financial modeling. I think it will be very interesting, and I'll see you. Thanks.